be here today, but unfortunately, due to various unforeseen obligations, he is not able to be here, including a large restructuring transaction that he is currently involved with. Just a few words before we start. Reed Smith has been very active in recent years in acting for buyers and sellers in trading shipping debt, and we as a firm have advised on transactions worth over $4 billion in the last 3 years. And in our experience, this area continues to be a very active market. Various banks are active, including German banks and UK banks, in divesting loans. It's fair to say there is distress across a number of sectors in shipping, particularly in dry bulk, container and the offshore sectors. So many expect that 2016 will continue to be a very active and interesting year. Now, just to introduce the panel, we have Mr. Michail Zekyrgias, who's the Managing Director of Global Credit and Special Situations Group of Bank of America Merrill Lynch in London. Michail specialises in the analysis, acquisition and trading of single-name stressed and distressed credits, as well as in the analysis and acquisition of performing stressed and distressed loan portfolios in a variety of sectors, including shipping. We have Mr. Martin Hugger, the Managing Director of Oceanbulk Maritime Deutschland, GmbH. Oceanbulk is a company that focuses on finding structured solutions and investment opportunities in distressed situations in shipping. And prior to that, he was the head of the Greek shipping portfolio at Commerzbank. Mr. Mehmet Saydam, who's the Managing Director of RB Capital. Mehmet has covered natural resources and commodities in emerging markets for over 20 years at institutions like Deutsche Bank and Goldman Sachs. He joined Reuben Brothers in 2012 and is responsible for natural resources investments. And finally, we have Mr. Samy David, who's the Managing Partner of Grifon Capital Advisors. Samy is the founding partner of Grifon, an advisory firm which specialises in capital structure, special opportunities, non-performing loan acquisitions, and principal financing. So to get the ball rolling, Michail, if I may start with you, I think it's fair to say there is significant distress across a number of sectors in shipping at the moment and beyond. What do you think 2016 will hold for the secondary debt market in shipping?
Tough question, to be honest. The reality is, I believe it's going to be probably a buyer's market. There is probably going to be less buyers than there was perhaps in 2014 and 2013, where we saw that the market was very heated from the investor point of view. And there are going to be, as you mentioned, quite a few distressed situations, and so a wide variety of investment opportunities that buyers will be able to explore. Now, why will there likely be less buyer interest? Perhaps because the capital within those investors is competing with other opportunities as well. And as you know, the offshore sector is quite distressed. The commodity sector overall is quite distressed. So people will be able to comp investment opportunities in shipping with a variety of other distressed sectors as well. And I'm only obviously referring to distressed opportunities, not performing opportunities. So the universe of eligible investments that one will be able to look at is much wider. And then if you take some markets overall, they have significantly reset. So the high yield market, for example, in the US, has priced quite a lot wider in the last few months. So again, that's another competing pool of capital or a competing pool of eligible investments for people to consider. So that is why I believe that there may be a bit of a less buyers, a bit more of a buyer's market this time around. However, on the positive side, a lot of people have done a significant amount of work in the shipping industry. They have built up the knowledge, which is there. They have built up JVs. People know how to access information, how to deploy capital. So for them, if there is a good opportunity to invest in, then they're ready to push the button. Perhaps for other sectors like the offshore sector or certain of the commodity sectors, people are still coming up to speed with those sectors, and it's going to take some time before they can effectively and reliably deploy capital in those sectors.
Well, thank you for that. Moving on to the dry bulk sector, which seems to be going from bad to worse, it's fair to say. Martin, do you see the current state of the dry bulk sector as an opportunity? A number of buyers of distressed debt have reportedly taken significant losses on those investments to date. Is there still interest in this sector over the next 12 to 18 months, in your view?
Well, I think that's probably a difficult question overall. If you consider yourself being an associate in a buyer's fund and you have invested a few $100 million in dry bulk, and those three, four, whatever, 100 million have been wiped out, you probably will think very hard before you go to your boss and say, I think now the time is right to buy. But as we all learned at business school or wherever we've been, sunk money doesn't really matter if you take a new investment decision. So if you haven't invested in dry bulk and your view is that the price is low and the future market will be better than now, you probably buy assets at a very good price and you can make a decent return on that. Whether this will happen depends on the individual players out there.
Well, thank you. Let's see what happens in that sector, because that's a very interesting one. Moving on to the offshore sector, which also has had its troubles. Mehmet, there is a huge amount of distress in the offshore market. Will we see trading in distressed debt positions for offshore assets in the same way that we have in other industry sectors? Or is it the case that the offshore assets are far too specialised and difficult for and costly for investors to tackle?
Can I have the next question? Well, I think the offshore industry is I look at it in a kind of a binary situation. These are very big businesses, very single party exposure, in binary in the sense that either it works or it doesn't work. So in the dry bulk, anything that goes wrong, it goes wrong. It might go wrong even further wrong. But at the end of the day, there's always a point at which you could recover. In the offshore industry, either that kind of works and then you get some sort of a return on your money back, or you are in a fairly disastrous scenario. And to be perfectly honest, we've been looking at a variety of transactions like everybody else, I guess, in this room who deals with distress. And I have very much difficulties trying to gap the bid-offer spread that there is between what the seller wants and what we think is reasonable to achieve. Which, by the way, is the reason why the number of transactions in 2000 and now are getting tougher and tougher. We've done maybe, the opportunities were maybe bigger previously, but now it seems that the bid-offer spreads between what the seller wants or is able to digest as a discount, as a loss that they need to write, and what is reasonable to be done is getting wider and wider.
If I may continue with another question to you, if that's all right. Given your experience...
I knew I shouldn't joke.
in your area. What in your view drives a particular interest in distressed shipping loans and portfolios? Why shipping as opposed to other sectors? Is there something that drives an interest in that?
I think our colleague Michael mentioned it quite nicely. I mean, I don't know about, I guess maybe not for Oceanbulk, but for us, we can look at any industry, right? So, and in fact, the best recipe for disaster is to get even the best guys on the planet and give them a growth target on one industry only. You say them, you have to do shipping, and now from now on, you have to grow. And at one point or another, they will hit the wall. That's inevitable. We can do pubs, we can do restaurants, we can do marinas, we can do anything that is in distress, as long as it makes sense. And shipping has a difference for us where there is a certain entry barrier. In the sense that for distress, you've got a lot of people doing credit cards, right? A very low entry barrier. You just need a couple of statisticians and then they will come. Shipping, I guess if I were to ask for a raise of hand here of people who have been in this industry more than 80% of their business career, probably 100% of the people would raise an hand here. So you have to be specialized. So for us specifically is because of that entry barrier and specialization that we look at shipping. It's not time dependent, so probably you were expecting from me an answer of the type of saying there's so much distressed assets that right now it's a good time to be in a distressed in shipping. I don't believe so at all. I think, and I don't know what my colleagues think of it, but I perceive the shipping distress deals to be like being thirsty in a rainforest.
That's I think, a very good, well, interesting analogy there. Moving to Greece, Samy, generally, we have seen recently Greek banks looking to divest problematic loans, and in particular in the shipping sector. How do you see the current situation in Greece will influence the decisions of Greek banks in this regard? Will we see a significant deleveraging of shipping by Greek banks, in your view?
I think this is the most difficult question that anyone could actually get.
I'm not picking on you, so anyone else can answer it.
You know, most of us live in Greece, so I guess you've been following the Greek bank drama for the past years. So the big question is as to whether the Greek banks are going to deleverage or not, is whether there is capital or not. Is there enough capital for the Greek banks to actually sell their portfolios, the non-performing portfolios, or should they hold on to it? And that's not only for shipping, but it's also for all the portfolios that are available in the Greek banks. I personally think that the Greek banks are slowly realizing that managing non-performing loans is not what they should be doing. They should be generating credit. And I think that is why you have quite a few of investors sniffing around in Greece trying to actually purchase the portfolios. I think that the Greek banking shipping sector doesn't differ much from the German one. I think that Greeks were actually faster than the Germans in that particular respect in restructuring portfolios. And I personally expect 2016 to have a pipeline of distressed portfolios coming into the market.
So more to come, so to speak. There's been a lot of talk in recent years about, obviously, KG borrowers and the situation in Germany. So Are there any, Martin, are there any unique issues to consider when advising specifically KG borrowers?
Well, I think if you consider buying KG debt, it's more or less on the economical side the same as if you buy debt from another SPC. If you buy debt on a vessel that's worth 10 million, the vessel value might drop to 8. You may have debtor in possession finance, which brings your leverage up. But commercially, it's more or less the same consideration. On the legal side, it's slightly different. When I started off in shipping, we had some New York law documentations where you had a truck outside with the documentation. We had some English style where the lawyer came with a big suitcase full of documentation. And on the German side, it was 3-4 pages, sometimes 12 pages if it was a lengthy document. And all of that was in German, and it looked the same each time. And what also was different is that the English or American style documentation was done by specialized shipping lawyers that charged a fortune for that, whereas the German documentation was done by a clerk somewhere in the mid part of her career that usually didn't drive a Ferrari or not even an Audi, but came with a subway to the office. And she just changed the name of the SPC, changed the vessel name, and put in new numbers, and that was about it. What means that for an investor? It means that first you need to understand the language, German, then you need to understand the general business condition and the general lending condition that was attached. That is not shipping special, but it's for lending or for general business of the bank. And at the end of the day, you may want to go to the town of Nibel, which probably only very few people know where it is, where a court sits that deals with insolvency in KGs in the northern part of Schleswig-Holstein. And when you go there, you might find a judge that doesn't want to talk to you and say, go back to HSH or Nordlb or Commerzbank, because these guys are the decision takers. And when you say, I bought the loan, he said, oh, fine, but still I don't want to talk to you. I have appointed a receiver somewhere in Hamburg. His name is Tim. Go there, see him. So you need to deal with some specialities that are different than in England or in the US. If you're prepared to do that, you can do it.
Thank you, Martin.
Could I just a quick question? Is it just specific to the KG loans, or is it just all the loans in Germany?
Well, if you do a corporate loan in Germany, it's often a little bit more lengthy than the KGs, because KGs were factory manufactured in a way. You changed the name from Oceanic 25 to Oceanic 26, and the vessel was not called Erika, it was called Ursula, and that's about it. In corporate lending, you often have a little bit more documentation, but still the code of law applies to that, and especially smaller institutions, they will have an in-house form how to do a loan to a corporate.
Okay, thank you.
When we're looking at the sale and purchase of non-performing shipping loans, there's always a borrower involved somewhere in the equation, and usually it's very alarming and difficult for the borrower to discover that they are on a sell list, and particularly where there's been a long-standing relationship with their bank or financial institution. And this is a question for all of you, really. What advice would one give, or what would you give in those circumstances where that borrower has been reliant on covenant breach waivers and other such matters?
I think the fact that a borrower is on the sale list doesn't really mean anything or there is not much to read through necessarily from a secondary investor point of view. Certain banks have borrowed on the sale list because that industry has become non-core for them, or that subsegment has become non-core for them, or that because they need to reduce NPLs for a certain reason. So as a secondary investor, to me, it does not really mean anything that specific borrower is on the sale list, and I do not price my loan differently because that borrower is on the sale list, and that other borrower, ideally wouldn't be on the sale list, but it happened to be on the sale list. So, secondary investors, I think, price loans on the basis of their parameters, whether that is, the value of the collateral, the strength of the security package, the quality of the loan documentation, other guarantees, the quality of the business of the borrower overall. So I don't think there is anything alarming about that. Now, in relation to the question of how a borrower should approach the secondary investor, I think it's the same way that he would approach an existing bank relationship. So every investor invests in the business because one investor has a thesis. There is an expectation to be able to make money with that investment in a certain way. I think investors will discuss their thoughts with the borrowers. They will perhaps have agreements in certain parts and agreements in others, but I think always investors invest with a mindset to work with the borrowers and to achieve something that is beneficial for everybody. There are very few circumstances in which that agreement cannot be reached and perhaps a relationship breaks. But I think in the vast majority of cases, even in, let's say, Chapter 11 cases, in the end, there is an emergence from a restructuring which works both for the borrower and for the investor.
May I add something? I would be very happy if I was on the sell list, because there's certainly going to be a resolution to an issue where you are most probably in a negative equity territory, so you're not expecting anything from that particular investment, then you are expecting something to happen. And usually the buyers of distressed debt are faster, more creative, and are willing to share their upside with an operator. So I would be extremely happy if I was able to communicate with a private equity investor rather than a banker, because that would mean that I would be able to make up for the losses that I've already had due to my investment already.
Similar view here. I think first thing is don't panic. When you're in a troubled situation, the guy you've been talking to on the relationship side at the bank is probably not the prime contact person anyway anymore. So you talk to the restructuring unit, and there are different people in there. It doesn't really matter whether you talk to a restructuring unit or you talk to a new investor, you talk to someone new where you haven't built up a relationship. And when you talk to someone new, a private equity firm or a specialist who has invested, it's usually rational people. They don't have legacy issues. They have less regulatory restrictions, so they can do many things that a bank would want to do but cannot do, and they have a lower price as an investment point. So they have a different maneuverability than a bank has in the restructuring unit. So I would take a positive stance and say it's a chance for me.
Well, I have to disagree because somebody has to disagree, right? Yeah. So let the Turk to disagree. I partially agree, of course, it's not dramatic. But let's remember that often what happens is that the borrower and the bank do not really realize how dramatic is the situation. And is this poor little, structuring guy that comes and reminds everybody how the situation is dramatic. So usually, effectively, what happens, yes, it's better to deal with the investment banker who actually is there in a much happier phase. I compare the distressed people, these distressed investors like we ourselves, like marriage counselors. So something has broken up between the borrower and the bank, and that guy comes in and you know, often we had cases where at the end of the day, the marriage continued. I mean, because of the terms that we proposed, both the bank and the borrower realized that it's on their best interest for both of them to continue their marriage. And, you know, we're all happy. But at the end of the day, what the distressed guy is the reality check. Is the guy who comes up and tells to the bank, no, you don't have 70% LTV. You are at 150% LTV. And that's the guy who goes to the borrower and says, no, sorry, you don't have any equity left there.
Maybe he's the mistress rather than the...
Well, there's a lot of analogy.
I think, sorry, it's just fair to say that, you know, people, I think banks and secondary investors probably have a different approach, right, to the same problem. So we have to be fair to the banks and say that the banks have long supported this industry, a very cyclical industry, right? It's not very easy to lend to from the primary side, frankly. It is very difficult to lend to this industry from the primary side. And have weathered several storms in the past. So, you know, the banks have their own way of working things out. Secondary investors may or may not agree necessarily sometimes with the way that they work out situations. But probably, you know, both ways can coexist. It's simple, it's only that, you know, the banks perhaps cannot afford to restructure all the loans in the same way, or perhaps they cannot afford to keep the same volume of NPLs on their books forever.
Well, carrying on from that and the relationship between the bank and the borrower, which is obviously an important one, why do we see banks choosing to sell rather than enforce? What determines the decisions of a bank, do you think, to sell rather than taking enforcement measures against a borrower, which was the traditional remedy, of course?
I think that banks are better equipped to manage performing loans. A transaction that has gone sour needs to be ended up amicably rather than through enforcement. The recovery is going to be better if there is an amicable solution. And usually investors provide a more creative way of solving a problem and also don't have the moral hazard of actually haircutting a loan. So I guess that I would go for selling a portfolio rather than actually enforcing, which might bring about super seniors and stuff that I wouldn't expect.
From my experience, it is a cleaner and an easier process for the banks. So to sell a loan, it's very easy. There is a contract that you enter into with a purchaser. Typically, it's a standardized contract. It's an LMA standard and an STA standard. So the banks are very comfortable with that. And then you pass on the entire problem to the secondary investor. So it is a very clean process. It doesn't leave you with any residual risks, and it does not leave you with a residual exposure either. If the alternative is enforcement, that means that you need to sell the asset. But if you're not comfortable that in an auction the asset is going to achieve its reasonable or realistic or real market price, then you probably have to reposition that asset with another investor that you feel more comfortable with. In that case, then you would probably have to finance that investor, and the loan is still going to remain in your books. So selling the loan really deals with the problem from the beginning, and it is clean. You have a price, and that is it. Enforcing the asset and either selling the asset in an auction, then that is a price that you cannot necessarily calculate in the beginning, or there may be a risk that you may need to hold the loan in your books for longer.
I think it might be, would it be right to say that, going on what we were just saying a moment ago, that selling doesn't necessarily burn bridges, whereas enforcing probably does. And in terms of the relationship, enforcement is a far more drastic and bridge-burning measure, I would have thought.
Can I disagree?
Of course.
So I think your real question is why, and I hope there is no bank right now there who's about to sell us any of their loans, but your real question is why is a bank willing to pay me a premium or accept a discount, which is the same thing, right, for handling this loan? That's the real question. So the loan was initially, let's say, worth 100. Now is worth, with everything, you know, assets and all the time that you need to spend and etc., is worth, let's say, 50, right? The real value is 50. He's going to sell me that, and I'm not going to buy it above 50, right? I'm going to buy it at 40. So the real question that you're asking is that why is it the bank, perfectly capable institutions, agreeing to pay this 10 to somebody else to take care of these problems? Burning bridges, well, at the end of the day, you burn a bridge when you sell it. And then the guy is already marked for exit if you're selling it, which means that for a certain time already, maybe too long, probably too long, this has not been dealt, as Martin said, by your relationship manager anyway. It has been dealt by somebody else. So the bridge has already been burned. So the real question is, why is the bank willing to pay this 10, 15, 20 as a premium so that somebody else takes care of it?
Shall I answer that directly? Yeah. I think there are several reasons why a bank may want to deal with a situation. One is if you think the owner of the vessel is no good, he's stealing from you, he's not managing properly, has high costs, whatever. What you do is, as a bank, you just switch the owner. You go like when you have a soccer team, you change the coach. And then you can say, okay, the owner runs out of liquidity. You also find someone who will be willing to invest and provide liquidity. So the real situations where you sell is where you think the asset is no good any longer, asset has no future, which needs to find someone who has a different view. If your view is there is a future in the asset and the bank thinks there is no future, then you probably can agree on price and there is a margin there. And the other one is regulatory issues. If Brussels or someone else imposes new rules on you, then you may have to sell even though you think it's still a good solution to restructure, but you just cannot afford from balance sheet point of view. And this is where opportunities lie.
Thank you. I actually have a lot more questions, but unfortunately time is of the essence and we have to conclude. Do we have time for some, maybe a quick question from the...
What does the clock say? Are we out for 4 minutes?
We've been out since we started.
Well, we are half an hour late, so I apologize.
But we are in Mediterranean, so...
Well, if we have time, if someone has a question for the panel. Well, no question after all, so there we are. Oh, no.
We found one.
Yeah, I was curious. You guys sound like a new kind of distressed investor. But up till now, it's always been quick turnaround. Now you talk about finding traction in the asset. It sounds like you're holding on to these assets longer term. Or am I mishearing it? Are you guys a new kind of private equity or distressed investor where you're going to hold the asset or hold
Is
the
this
debt?
the four of us or one specific?
All of you who are talking about the quality of assets and you might be a better place to park.
So, no, we have, I mean, I guess the distressed guy is the guy who tries to make sense out of a situation which is kind of lost it. So you can't just put one, we had a deal where we owned the asset for exactly 1 hour and 6 minutes. So
that's not long term, okay.
That's how long term we go. No, I mean it's you can't put you cannot put a template and say this is precisely what templates creates business for us. Is other people's templates and let them stick to it. I mean, the more they stick to it, the more we will have businesses.
And also in terms of term, I think that private equity investors would never want to become ship owners or operators of ships. It's cheap, you buy. It's not cheap, you sell it. It's the question of time is.
Just to disagree. No, we own and we want to hold, and if there are things that we can hold, but you got different categories. You have things that you do on the equity front, you have things that you do on the mezzanine front, you have things that you do on the debt front. We ourselves tend not to do the debt side, not to compete with people who are much better at us than we are. And the equity is more stars needs to be aligned in order to do the equity. But of course, it's no templates. Sometimes maybe you want to refuse to do debt, but there's one deal that is absolutely debt-driven and makes perfect sense, and the other one, if you don't do the equity, you just stupid. So, no template.
And I think only to add that here the theme is non-performing loans, right? So in reality, you're buying a loan to start with, and you're buying a loan with a strategy. It does not mean necessarily that you're buying a ship, right? Your collateral is the ship, but you're buying a lending relationship, which may be stressed, may be distressed, or may be capable of becoming performing very easily. Obviously, you need to be able to underwrite it with certain base cases and certain alternative cases, and obviously you need to be able to have an investment horizon that allows you to make the recovery you would like to make on that loan. But it does not really necessarily mean that buying a loan, you're going to become the ship owner.
Well, thank you. Thank you, ladies and gentlemen. That concludes this panel. Thank you very much.